Welcome to Making the Deal, Frameworks for Transactions, the podcast focused on lower middle market deals and how to bring them to a close. I'm Shawn Mercino.
And I'm Joe Allen.
Thanks for joining us today. A quick recap on our last podcast. It was packaging the deal. So that was what is a package, right, for the deal? How is it put together? What does it include? Who's involved with it? Obviously, there's a lot of people, both internally, your internal staff, and externally, your CPA, possibly your attorney, often your broker or investment bankers involved. So we just kind of talked about packaging the deal,
Sure.
Whether that be for the eyes of a lender or for the eyes of a buyer, right? There's a lot of people who can look at the package. So we talked about the core components of that. It was a good podcast. Take a listen. Today, we have John Klehm with us, SVP in asset-based lending. We're really excited to have you on and to chat a little bit with us about it. I don't know if you want to give a short introduction, and then we'll dive in.
Yeah, thanks, Shawn. Thanks, Joe. Good to see you guys. I've enjoyed the podcast, so I'm a listener or a watcher. Actually, a watcher more than a listener. Appreciate the opportunity to be on, and happy to talk about asset-based financing. In terms of my own background, I've been a commercial banker, really starting 30-something years all in. About 20 of that is in asset-based finance.
Okay.
5 sort of larger ticket deals, and the last 15 actually with my current shop that does really call it $8 million and below deal sizes.
Okay.
Asset-based finance.
Okay.
Great. Well, hey, John, we're really happy to have you here. You and I have been working together on deals for a long time, and really happy to have you on as a resource here because your experience is going to go a really long way in explaining what asset-based lending is to people.
For sure.
As a whole.
It's a niche.
Before we jump in, I do want to ask everybody to like, subscribe, all those good things on Apple, Spotify, YouTube, all those kind of things. And please leave feedback. We love hearing what people want to hear in future episodes and like what you think of our current content. So if you got any comments on what John drops today, if you don't like it or you do love it, which we expect you're going to, let us know in the comments. We appreciate it.
Quick plug on that, Joe. We are now live on TikTok. So if you, any listeners out there on TikTok, take a look for Making the Deal, and you'll see some different innovative reels from us with the content. So to Joe's point, we're on all the platforms.
Yep. Okay, so we are talking today about asset-based lending.
Mm-hmm.
We're going to talk about where it's used, how it's used. You know, it is an alternative to bank financing, as most would call it, commercial lending.
For sure.
It's used for a lot of different types of situations, some similar to bank financing, some very different.
Right.
We're going to talk about like what you can expect from this because it is very different tool from bank financing. Like you've got different requirements of reporting and all those types of things. So we'll dive into that a little bit. We'll talk a little bit about like what you can expect from your lender, but all through the diligence process, but also after the fact, like what are your reporting requirements, all those kind of things.
Sure.
And then, I think what's really going to be helpful for people is talking about like some of your success stories, some of the different things that you've been able to successfully. And look, maybe it ended up good for clients in the end, like they could pull a rabbit out of the hat and they really did some great things with the company, or, maybe it went the opposite direction. You never know. Like it's,
For sure, it's higher risk lending, and most of our clients are ultimately successful, but sometimes not.
Yep.
But yeah, we've certainly been a part of some great success stories, and we're happy to talk about those.
Yeah,
very much so.
I'm looking forward to that. So, Shawn, why don't you get us started here?
Quick primer, right? Just from the banker's lens, the traditional senior financer. There's situations where with an existing customer or perhaps a prospect that usually jump out to me that signal to get somebody like you involved.
For sure.
That could be a lack of cash flow.
Right.
And that could happen for a variety of reasons, a road bump of some sort.
Right.
Maybe the balance sheet is a little challenged, and that could be for a variety of reasons too.
Right.
Maybe the collateral isn't specifically appetizing to us at the bank. And then ultimately, right, we're always subject to regulators.
Sure.
So whether that's from a federal level or from our own credit box,
Sure.
that could limit us on what we can do. So those are kind of some scenarios as a senior financer that I would think to give you a ring and help guide us.
For sure.
But I'll let you dive into a little bit more about what ABL is, what it looks like.
For sure. So asset-based lending, I think broadly is like commercial lending, commercial bank lending. Although typically, and this is how I try to explain it to borrowers, is that really a bank wants to be paid from cash flow, which we all know. But really, what does that mean? The bank really wants to be making a loan to a company that is kind of firing on all cylinders, has a healthy-looking balance sheet, not excessively extended in terms of the net worth being very small relative to the assets, or has consistent earnings. Once you get into a situation where the balance sheet's extended, the net worth is tiny for either due to losses or due to dividends sometimes, the banks can get uncomfortable. Really what that tells the bank is that balance sheet has fragility to it.
Sure.
And that's not really kind of the way the banks are structured to lend. And part of that is for sure regulatory. And we all have regulatory bodies that we deal with to some degree. And the banks, look, the way the regulations are written, the banks really want to lend to companies that are over the plate in terms of consistent earnings, not too extended of a balance sheet. And once you get inconsistent earnings or maybe more serious losses, then it isn't really a fit for a bank. And so an asset-based lender whose focus is more on collateral, whereby an asset-based lender can provide credit to a company based on the collateral, and they're not so much relying on the balance sheet or the income statement.
Right. And look, I don't want to harp on this too much, but it is very true. Like the regulators have, it's like a checklist now, right? Like you got to think of 30 years ago, you could have straight relationship-based lending. Like you could take somebody's good idea and lend them money on that. It's not so true anymore. Like you've got to hit boxes. If you're not using like a SBA or something like that, which don't get me wrong, has its own check boxes to. But like there are boxes that every bank has to fit in based upon whether you're large bank, a mid-sized bank, a community bank, or credit unions have a completely different like set of. Almost non-regulations.
It's an important point.
Yeah, and as we talk about sort of what we maybe think is coming in the future, actually, I'm candidly kind of optimistic for the banks. I think, not to be political, but just I think with the recent election, my expectation would be that the banks might be getting a little bit more room.
Yeah,
and we'll talk about that more.
Totally agree.
On.
Yeah,
totally agree with you though.
That's a great point. So when you talk about the structure of ABL. Are there considerations or industries that it works better in?
Yeah, for sure. So really, being asset-based lenders really want collateral. That's what they want. And so what's been proven out, if it's something that's been referred to us, the income statement is no longer reliable as that primary source of repayment. And so the lending decision then falls to the collateral as a secondary source of repayment, and that's what we really rely on. And so we want to feel like there's good collateral. And collateral could be accounts receivable, could be inventory, could be equipment, could be real estate. And depending upon different ABLs, they may not want to lend on all those asset classes, but we'll talk about that maybe a little bit later too. But yeah, so in terms of industries that we like or that are fit for asset-based financing, it's really it really is their collateral that if the company shut down, if the company unexpectedly shut down, could that collateral be sold? Could that collateral be collected out? And could the asset-based loan be repaid?
Yeah.
I'd say commonly what's good for asset-based lenders would be companies in the transportation space that are receivable heavy, wholesale distribution. But I would say, a lot of manufacturing companies too. We, in terms of my own business, we're very active in the manufacturing space where you have, particularly in our area, with machining companies, molding companies, fabrication companies that have good equipment and they've got good customer relationships and they provide parts maybe for those customers. So it's really about, is there good collateral? Is there enough collateral to secure the financing and help the company move forward?
But there are like no-go industries, right? I mean, and there's stuff like contractors are typically not going to be a fit. Any business that gets progress payments is going to be very difficult. So there's certain
100%.
things that are offsets to like what an ABL will fit. Even though the industry might make sense, the way they get paid might not work for an asset-based lender.
100%. Right.
Yeah.
If those industries, contractors and machine builders would be the two biggies whereby, hey, if they shut down, then those receivables might not collect out, the inventory might not really liquidate for much, and so those are very difficult.
Okay. Awesome. And I guess a quick question I'm thinking of on the fly here.
Yeah.
Do you see in the ABL structures often, is there ever AR insurance?
Sometimes.
And if so, is it tied to the customers more so, or is it tied to your customer, meaning the customers of your customer, or is it customer specific?
We typically don't require credit insurance, but we like it if our prospective clients have it, because it actually does two things. Credit insurance does two things. It provides obviously an additional source of repayment if the end customer is financially unable to pay. Then you've got insurance there. But two, because the credit insurance company is looking to mitigate their own risk, they're doing very good due diligence on the creditworthiness of those end customers. And so they're actually a great early warning system, like, hey, there could be financial stress. They have resources that are much deeper than us in terms of being able to understand the creditworthiness of some of these end customers. And they're a great warning system to say, hey, there's distress with these end customers.
Keep an eye out.
Keep an eye out.
Right.
So and that's a really good point. I didn't even think about that, because it can be an enhancement to like a really troubled company. You're like, okay, I really got to protect myself. But B, cross-border, like when you're even going into Canada, like you don't think about it as like, hey, that's another country, because
it's right
feels
there.
like
it's
it.
Right
Yeah,
there, right.
especially Detroit, right? Yeah, exactly. But yeah, I mean that is commonly used to help people get comfortable with Canadian receivables, definitely Mexican receivables. I mean, exactly. So
yeah, for sure. So in those situations, we would expect credit insurance for Mexico, China, almost certainly. Candidly, once in a while, we can consider Mexican AR as eligible without credit insurance. Selectively. It really depends upon who the end customer is, but. Yeah, we like credit insurance broadly. We think it adds a lot of value.
Not a mainstay of the structure. It's an enhancement.
It's an adder.
Perfect. So I guess maybe at a high punch list level, what situations is ABL used in? And then I know you and Joe will dive into that a little bit further.
Yeah, for sure. I mean, I would characterize it really kind of three ways: kind of stabilization, or kind of long-term sort of lender fatigue situations where a bank has been a lender for a company. And management, for whatever reason, hasn't been able to, they've maybe consistently lost money, or the bank is just worn out. They've lost faith that management can turn the business around. And so there's equity in the assets, and we can pay out the bank, plus give management some additional runway to continue their efforts to turn the business around. So I would say that's really kind of the core of what we do.
Yeah.
And then other situations are turnaround situations whereby maybe a company is like that company is struggling and maybe in kind of long-term decline, but they've engaged with a consultant who has maybe helped them and maybe change some structural things, pricing with customers or cost structure, maybe kind of how they do things, such that there's the prospect that they'll make money in the future. And so again, the existing bank has heard that story before and would just as soon move on. So we can be that that interim source of financing to help the company out of the existing lender, give them some fresh availability, but they're with a consultant who's got a strategy for them whereby there's a likelihood that they're going to be successful in the future. And then maybe the third is we work with buyers of troubled companies. These are very good operators who can really, not say take control, but really can acquire a company that's in decline or has suffered losses, or maybe existing management just is tired and they're just like, they can't figure it out. And so we very much enjoy working with very good operators who have the ability to restructure those businesses and turn those businesses into very successful and profitable companies. And I'll share an example or two of that kind of later in the podcast.
Well, let me ask you, because we, at Mid-States, we have used asset-based lenders for basically all of those situations that you just talked about. Acquisition financing, obviously, and sometimes it's just a good fit for like certain kinds of growth, right? Like it doesn't even have to be acquisition. Sometimes it's just, look, my bank is limiting my capabilities to X, Y, and Z, or my borrowing availability to X, Y, and Z. you might be able to provide more on an asset-based structure than the bank is willing to go to.
Joe, that's a great point. And I left that out simply because it doesn't come up on my radar all that often. But
Right.
for sure, there are companies that are growth companies out there.
Mm-hmm.
And you know what? They get to the extended balance sheet that we talked about, not due to losses, meaning the equity getting dissolved through losses. They're actually have an extended balance sheet because they're growing so fast. And yeah, we very much like to finance growth companies that are, but again, you get to that, again, it's a fragile balance sheet.
Right.
And is
Yeah.
this really a place for a bank if you've got this very fragile extended balance sheet? So yeah, for sure, we love them.
And then on the most common one that I see is the stabilization case.
Yeah.
Not the turnaround situation, but really the stabilization, where
Yeah.
it's like, okay, to your point, good company, been around for a long time,
Right.
maybe been a long-term customer of a bank.
Sure.
And the bank doesn't want to harm the company, but they're not a fit for the bank right now, right?
sure.
And they want it to eventually be returned to them.
Yeah.
You see, I'm sure banks are some of your best referral sources.
Very much so.
They call you directly and say, look, good
Yeah.
company here. Can you help them? And then, keep us in mind on the other end.
For sure.
Do you have any good examples of that? Because I think an example to run through that as we go through
Yeah.
this will really help people kind of put the image in their head about what that looks like.
For sure. I've got a great example. It's earlier this year. Great guy. So you have a manufacturing company, I'll just put it that way, in the metal space. And he is, so he's a he's about a $5 million borrower. And very well regarded at his bank. And his bank, I'll just leave it at this. There's a very close relationship between him and the bank management and ownership. And very valued client. And the owner of the company was subject to, he had a bad finance person and was subject to a fraud and thought he was making money. Really, he had some responsibility here too and really wasn't watching things as close as he should have. But wakes up one day, large loss. And tells bank, and so for sure. So he's wise enough to get some help, got some third-party advisory, and took the correct steps to sort of uncover that, document that, approach customers and sort of seek some relief to help him through this period. And for sure, and in that situation, we completely expect that borrower to go back to that referring bank. And we appreciated being trusted with this really very valued company.
Yeah.
And so again, good.
It's like
good
a
person,
blip.
Yeah, good person. Generally a good operator. I think this has been a good experience for him. He's not going to make that mistake again.
Yeah,
In terms of he's going to be watching his own financials more closely, and and strange things that don't make sense to him. He'll get
Get
answers.
them covered.
Right. Okay, so that's really helpful. I always think examples are the best
Yeah,
way to
for
explain
sure.
away how something is used. Okay, so now we've talked about the situations where it's used. What is an ABL looking for in its borrower? Because, like we've already said, it's very different from your commercial banker, what your commercial banker is looking for. So, maybe just run through some of the what are you looking for when you start talking to somebody?
For sure. So really, at the end of the day, we want to be able to. We're going to look at the assets and we're going to make an assessment how much we can lend them to what we consider safely. So if they call us in 90 days or 120 days or 180 days and say, you know what, we've given this kind of our best effort, we're going to close down and wind the business down. We want to feel like, okay, the business will wind down and we'll be successfully repaid. So that's our underlying sort of fundamental sort of number one thing that we're looking for. And so when we look at the company's assets, we're looking at accounts receivable, we're looking at inventory, we're looking at equipment, looking at real estate.
Right.
And so we're going to make an assessment of those assets as to what those return in a wind down type situation, and we want to come up with a number and says, hey, Mr. Company, we can provide you X dollars in borrowing capacity, and hopefully that's less than what he owes his existing bank.
Yep.
And hopefully that's less than what he owes his existing bank, plus enough, call it dry powder or excess availability or liquidity, that he'll be able to effectuate the turnaround that he wants to do. And he might be losing $50,000 a month, that would be a very common situation where we've got a borrower, he's losing $50,000 a month, he's got a plan to turn the business around, maybe he's talking to customers, maybe he's going to take a second look at his cost structure, and so we want to be able to get him out of his existing bank, give him enough availability such that he can fund losses until we think is reasonable that he'll be able to make that turn.
Mm-hmm. Can I ask you a quick question when you talk about excess availability?
Yeah.
Why is it so important for lenders that they want to see, let's say you're borrowing, we'll just throw $3 million, and the lender says, we want to see $300,000 of excess availability. It does not have to be there the next day. And in certain situations, they know it's not going to be there the day after closing, but they want it at close.
Right.
Why is that such a sticking point? It's so silly.
Well, that number is highly subjective. With our shop, we try to be kind of, here's why. We'll come up with a number, and we want to be able to justify that. And so here's why we want 300,000 or 200,000 or 400,000.
Right.
Here's why. And with us, it's tied to what the forecast cash burn is or cash consumption is of the business. But you're exactly right. 90% of the time when we offer a credit facility, the borrower can draw down 100% of that excess availability at close. And hopefully they don't, but sometimes they do.
Yeah.
And so we just, it's just the nature of the business.
I understand the long term, we want to make sure there's enough capital to go forward.
Yeah, right.
But I've literally had lenders say, look, I know you're going to pull down this full thing tomorrow, but they want to see it at close. So
I'll tell you, Joe, what I'll say is in really tough situations, we will sort of meter it out for them occasionally. And I would say that's less than 5% of the time.
Yeah, difficult, really difficult
But really difficult situations where we don't have confidence that management will use this fresh liquidity wisely, we will meter it out in pieces. So based on their forecast that they gave us, they say, hey, I'm going to need $50,000 a month. We say, okay, we'll give you 20% of it at close and over time. But
I always thought it was kind of funny when they just knew that it was coming out the next day. But okay, and then I guess the other part of it is when you're looking at the longer term prospects of the company. So you're looking at the collateral and you want to make sure they've got enough to pay out the lender if possible, all that kind of stuff. When you're looking at the near term viability, does that affect your how much you're gonna give them in an advance against collateral, or typically it's just look, these are industry standard and that's what we're gonna do?
Yeah, I think the formula doesn't change based on viability.
Okay.
So even a deep, I will say, I'll qualify that a little bit. We might choose to be somewhat more conservative on equipment.
Okay.
So whereby maybe your standard deal that kind of rolls in the door, we're going to offer, say, 80% of the auction value of that equipment is the borrowing capacity. Sometimes we'll offer 85. Sometimes we might offer 75.
Yeah.
And the 75 might be a situation where we have real concerns about the viability of the business.
Got it.
And hey, there's a greater likelihood that we get the stuff back in a relatively short period of time. We might take a more conservative approach. I would tell you from a competitive standpoint, though, that hasn't really come into play just because, getting back to the competition out there, we don't really do that. But I also think the economy has been pretty good, and the economy has kind of kept, maybe some of these struggling companies kind of around.
Sure.
Yeah.
Sure. Okay. Well, I guess, John, for professionals listening, or maybe the business owner who's listening, who isn't familiar with asset-based lending,
For sure.
can you maybe walk us through what a proverbial transaction would look like, both on the front end and then beyond?
For sure, like financial statement requirements or financial information requirements.
Yeah.
We'll sort of start there. So it's going to be similar to what a bank you would look at as a banker. And we like to look at the last 3 years historical fiscal year ends, get an interim financial statement, get a projection, and then we want to look at the collateral. So that's like the financial statements, similar to what a bank. And then we want the receivable agings, payable agings, inventory breakdown. Probably get an appraisal on equipment, appraisal on real estate. So And so from that, we'll look at receivables. We'll look at how receivables perform. We'll look at, and we'll determine an advance rate based on how the receivables perform. We'll look at inventory. We'll look at how that performs.
And what's the typical advance rate that you would do against receivables?
Yeah.
So typically, I would say it's 85% is the
Okay.
common thing. But I would say it could be higher. Or,
Yeah.
excuse me, it could be higher, it could be lower.
Yeah.
I mean, candidly, we don't like to go higher than 85%. Although I will say in the ABL industry, sometimes more than 85% is available. But sort of the math behind 85% is really 2 times dilution plus 5%.
Yeah.
And so that's how really the 85%, which is common in the industry, sort of came about, or is sort of the justification is 2 times dilution plus 5%. And what's dilution? Dilution is really simply anything that dilutes receivables that isn't cash. So if a company sells $1 million worth of goods, if more than 50,000 of that is charged off through bad debt expense, it's a return and like a returned goods or quality defective goods or bad debt expense, that dilutes. So what we want to apply is we want to understand if they have $1 million in sales and $1 million in receivables, how much of that's actually going to get turned into cash. And so if it's 50,000 or less, 85% is probably going to apply. But sometimes there's certain industries where dilution, higher levels of dilution is common, and some of the advance rates can move down. And I'll throw out, I know that you're active in the healthcare space. Healthcare is another industry that can be a little bit challenging to lend into. And again, with receivables, you have very high dilution in healthcare.
Specifically if it's insurance related.
Right.
Very high.
Yeah, that's where it gets, private pay is
Right.
easy.
For sure. And then inventory. Inventory we're looking for, so we're going to look at how does the inventory actually sell.
Okay.
And so, where the banks, I think, and I'll let you opine, right? I mean, it's commonly 50% of inventory, kind of raw and finished. Maybe you offer them something on WIP, maybe not, so depending upon circumstances. In the ABL world, we want to know, okay, out of the inventory, if the company closes, what can be sold?
Sure.
And that's how so sort of the difference between maybe bank credit criteria and ABL criteria, I would say inventory advance is probably the biggest where there's a gap between what an ABL really wants to do and what a bank may be doing already.
Okay.
And so, we spend a fair amount of time trying to understand the raw. Okay, if they close, who would be the buyer for this raw?
Yep.
And finished, are the customers going to take these finished goods that are on the shelf that the company made? And so, in that, we're looking at sort of how does that turn mostly.
Will you sometimes lend against work in process? Because I've seen it done, and it's obviously situational, but it's always at like a very nominal advance rate and those kind of things.
I would say when WIP is available, when it could sell for something in a wind down. And so you might have like maybe some sort of a metal processor or fabricator where they have maybe like aluminum or even steel, whereby there's $1 million worth of WIP. Out of that $1 million worth of WIP, maybe scrap value is $400,000. And you say, okay, well, scrap value is $400,000. We can advance maybe 50% against that, and we would.
What about a situation where like you're a sole supplier to like an OEM or something? I know that's not realistic for an OEM, but like you're such a key supplier that they can't go outside to get it. Would you guys look at WIP in that situation?
Probably not.
Okay.
But you know what? Every situation can be different. I would say it's difficult to do, and that's the OEMs and the tier ones can be difficult customers.
Yeah.
And yes, there's a likelihood that they take the goods. But there's also some likelihood that behind everybody's back, they've been teeing up a replacement supplier.
Sure. Right.
And so it's a tricky thing. If you've got good communication with the customer and the customer says, hey, either formally through like an accommodation agreement or informally say, hey, we're not trying to resource you, there's a conversation to be had there.
Yeah, no, that makes a ton of sense. But do you guys... How often do you actually order up like a valuation on the inventory in order to try and get, or is it usually just like, hey, we're comfortable type of thing?
So in terms of our credit culture, we actually use appraisals less than I would say the industry does broadly. We're more interested in if the goods turn, you're kind of implicitly demonstrating there's a market for the product. And so if the goods are turning, and even if you have an appraisal on stale or slow-moving inventory, how reliable is that going to be?
Yeah.
So we try not to rely on appraisals, but certain classes of inventory, we will get appraisals on them. And I would say commonly like consumer products, where it's like an end product, like a wholesale distributor of some sort.
Got it.
And it's like, hey, there's, we have actually, and you could end up having a higher advance rate than, let's call it 50% of cost, or you could do what we call 80% of net OLV, which is you get the inventory appraised and maybe it would have a very high liquidation rate of 80 or 90% of cost. Then maybe you're advancing actually more like 75% of cost. So that can come into play with certain types of inventory.
Okay.
Quick question before we move on to the next asset class. You had mentioned kind of banks being at a different lens on inventory. Do you see the market generally as banks being more aggressive on inventory than you guys are looking to be, broadly speaking?
For sure. And I just think it's, again, banks being balance sheet and income statement lenders, they're putting formulas 50% on inventory or whatever the bank might have.
Sure.
I think it's more of a control feature, not so much truly like, hey, we're lending 50% on inventory. No, the bank's really lending on the balance sheet and income statement.
Sure.
And the inventory is, call it, just kind of something to keep a bit of a leash on the structure. And so that would be, so as I might look at, a company that the bank is looking to move out, where are the difficulties where I might be able to offer less than what the bank has already advanced? I would say inventory is a common. Yeah.
Okay. Perfect. And then I know we were talking about obviously AR and inventory, and then you had mentioned machine.
Yeah.
What does that look like and the different type of values? Maybe educate everybody on how you guys approach that.
For sure. So borrower gets an appraisal on equipment, and there are three values: fair market value, orderly liquidation value, and forced liquidation or auction value. And sort of three. And the borrower's like, hey, my stuff is worth fair market value.
Yeah, right.
And so really the appraiser is assuming a liquidation time. And so that's really the difference in those three numbers, is really how much time the auctioneer gets to sell the equipment, to find a buyer. And so so that's the difference between auction value would have like a 120-day liquidation time frame. An orderly liquidation value would be more like a 180-day sort of time frame. And fair market value, candidly, I'm not sure, but it's just we're not really looking at fair market value.
I don't see too many lenders doing it on FMV.
Yeah, so I would say the asset-based industry uses either auction value or orderly.
Yeah.
And in the lower middle market space where we are, I would say it's mostly auction value. And really that gets to like the viability of these companies. And they might like, hey, they might not be around 6 months from now. And so I think when you have a little bit more integrity to the balance sheet, I think in the bank ABL space or larger ticket deals where you have some enterprise value, and there's customers, this company is important to customers, this company is important to suppliers, there's maybe resources for this company to be successful. I think orderly liquidation value is what's used.
Okay.
Yeah.
Perfect. And then I guess when we're talking about that owner professional who's learning about the ABL space, is there a personal guarantee component? And if so, is that pretty frequent? Is it infrequent? Almost standard?
Standard operating procedure.
Okay.
No, look, I mean, PG is, look, I mean, you could have a company where he performed very well for a long time, and maybe his bank agreed to let go of the PG because he performed great. And, so we would expect an owner-operator to personally guarantee the debt. And I would say if it's an owner-operator, pretty much 100% of the time, we're going to want some kind of a PG. But in the ABL space, I mean, what I try to tell my prospective clients is that we're not really looking to that guarantor as a deep-pocketed person who's going to pay us off out of his own bank account. We're really looking, so our job is to stay within the margins of the collateral. That's our job as a lender. So we make a loan that we say is within the formulas that we have prescribed, and it's our job to stay within those.
Yeah.
And really, our guarantor, we're expecting that guarantor to be our agent, if you will, on the ground,
Yep.
making sure that collateral doesn't
Sure.
They have to
disappear.
work with you, like
For sure.
especially in a case of a default or something like that, or a wind down. Like you need them to
Be involved.
talk to the customer.
Right.
Exactly, be involved, help transition appropriately, right?
No question. So in a wind down, your net recovery with a PG, with a no PG, is different.
Yeah.
Meaning
Sure.
customers find reasons not to pay that
Yep.
we aren't able to dispute. Maybe the good inventory disappears, the equipment gets damaged, disappears. And so having that person, so I characterize like, you're a kind of marshal the collateral, be the security guard, make sure the collateral doesn't disappear, work with customers to transition the work.
Yeah.
And if they do that, it's very unlikely that they would have to write a check. And
Sure.
the other example I give to prospective clients is, so for the company I work for, in our 30-something years making asset-based loans, one guarantor has written one check for $200,000, and so
Did he do something inappropriate? Was it a
I
fraud
don't even
case
know.
or
That
something
was-
like that?
I think
Because that's the case where I could say, like you said,
Right.
you guys are lending against the
Right.
value of the asset. So realistically, as long as nothing like crazy happens, you should be able to get out relatively whole if you're lending appropriately.
for sure.
So they really shouldn't have to come to the table, right? It
shouldn't have
should,
to. Right.
unless they do something inappropriate and there's fraud, and then guess what? You should be on the hook for that, right?
And it happens. I mean, and Shawn, as a
Yeah.
lender, that's the thing that we all fear is the fraud.
Yeah.
And so
We'll do a lot of crazy things and they may not be bad people. Literally, just when you're put into
Yeah.
a situation between like,
Sure.
how am I going to provide for my family, and like you do a lot of crazy things.
People do. That's exactly good people making bad decisions.
Yep.
And that does happen, and that's our big fear. And the PG helps us avoid
Sure.
that. I mean, I know sometimes in the ABL space, a lender will get by with a validity guarantee
Right.
versus a PG.
Okay.
Our culture is such that we just want, again, we're not looking to this person as a deep-pocketed person who's going to write a check.
Yep.
Their job is to make sure the collateral doesn't disappear.
Right.
Yeah.
And
I have utilized the validity guarantee in the past. Like everybody's sensitive to a personal guarantee, right? They think you're going to come in and take all their money and take their house and all this and that. But
Right.
it is. Validity guarantees have been useful for me in the past.
Yeah.
And they have. The reality is what a validity guarantee provides is like, look, whatever I put on paper is going to your point of everything is there.
Right.
These are my receivables. I am telling you, if
fraud.
I
No
defraud
fraud.
you,
Right.
I owe you.
For sure.
That's where it triggers the guarantee. But yeah. I've used it in the past. Not appropriate for every situation. Usually
For
with
sure.
like high quality
Yeah.
individuals that have performed well historically and are in that
Yeah.
interim stage
Sure.
that we
It's
talked
short-term,
about.
right.
Yeah, that stabilization where they had a one-time event that put them in an ugly situation. And
sure.
they're just getting their feet back underneath.
Yeah,
them kind of
100%.
thing.
It's a competitive world out there.
Mm-hmm.
And you're right. Could I have a competitor who would offer a similar financing with just a validity guarantee and
Yep.
we're going to want a full PG? That happens.
Yep.
And you know what? You can't win every battle.
Sure.
And you
Sure.
you try to be a high quality provider, and hopefully enough stuff kind of tumbles your way.
100%.
Awesome. So we kind of talked about what financial information is needed up front,
Yeah.
the collateral analysis, the personal guarantee analysis, maybe a quick punch list on ongoing monitoring,
Yeah.
and then maybe take us through the different types of ABL lending. I think
Yeah.
we didn't get into it earlier. We wanted to define what ABL was, but then
For
maybe
sure.
walk us through markets within a market
For
after
sure.
the ongoing monitoring.
Yeah, great. So ongoing. So again, at the underwriting stage, we're going to look at the receivables and inventory, particularly on a more granular basis, and the equipment on an auction value versus, call it, fair market. And then ongoing, the biggest hurdle for a borrower who's going into an ABL structure is the lockbox or the control of cash. And so when a ABL lends on a receivable, so we lend 85 cents on the dollar on a receivable, well, once the customer pays that receivable no longer exists. So we've advanced 85 cents on the dollar on this $100 invoice. that invoice has been paid. So that's an unsecured loan unless we've actually been able to have that cash and pay down the credit facility. And so a lot, it's called, generally called a lockbox, but controlled disbursement account. But so the ABL needs to have control of the collection of receivables as they get turned into cash.
Sure.
Pays down the line of credit. So the borrower coming into to me may have a monthly borrowing base that they submit to the bank. In an ABL structure, they're going to have a weekly borrowing base, and the cash coming in as customers pay on those invoices, that goes to the lockbox, pays down the credit facility, and then the borrower needs the money. He's got to pay suppliers, pay employees, and so he will take a draw typically weekly, and so he'll borrow that money back. So as those receivables are collecting out and paying down the credit facility, he's making more stuff, shipping more stuff, creating more invoices, and so it really enforces this sort of up and down mechanism in a line of credit, which a borrower should do, but oftentimes don't. But yeah, it really enforces that up and down, and in many cases actually reduces the amount that they would borrow. So our expense is a little bit more expensive than bank financing, but actually in many cases borrowers actually using less than what they were using before because of that mechanism of paying down.
Operating appropriately.
A little bit more efficiently.
So they're actually going to use a little bit less of the credit facility. And then, so it would be what's called dominion of funds or lockbox, controlled disbursement account, collection of the cash. And then there's going to be periodic collateral audits whereby we want to make sure that, the inventory accounting is still solid, the books and records are still solid, there isn't any fraud in the books. And so we'll have someone from our team 2 times a year, 3 times a year, maybe 4 times a year if we have, if we think maybe the books are weak, and they'll have, and there's a cost to that, but that's all explained up front, and we try to be pretty modest with those costs.
Yep.
Okay.
Yeah.
So those would kind of be the two things outside of normal financial reporting, agings, borrowing base reports, like you said.
Correct.
Those would be kind of
the 2 biggies.
Yep. Okay.
Yeah.
That makes sense. And I know we wanted to dive into maybe a brief differentiator between different ABL lenders.
Yeah. So asset-based lending. People say, "Oh, you're an asset-based lender," and I think there's a sort of a perception that ABLs all have the same sort of credit appetite or sort of same lending criteria. But I would say there's more variation in credit appetites among ABLs than there is even like commercial banks. And I think you both know that there's different credit appetites between banks, and in the ABL space, there's even wider variety. So even though we're all operating under the ABL umbrella, you might have like large banks have an asset-based lending department, and those organizations are making loans that are really extended balance sheet companies with levered balance sheets, maybe they have earnings, maybe inconsistent earnings, or maybe small earnings, maybe smaller than what the bank would really like. And so they put them into an ABL structure within the bank. And so these would be, again, bank ABL sorts of deals.
And most every large bank has one at this point.
I would say
it's
very common.
Because it's a good tool. I mean, it should just go to tell everybody that asset-based lending is a really strong tool for borrowers.
For sure. I think it allows the bank to continue to be a service provider for that company. And it says, hey, your risk profile has migrated to what's considered normal as an asset-based client. We'd like to service you in this asset-based structure. That'll help us manage our risk, and that makes us to be a good partner for you. And then you can kind of migrate back to the middle market when the appropriate time. And then so you've got larger ticket asset-based deals, and then you've got call it lower ticket asset-based deals or lower middle market asset-based deals where I'm more active. And even in this lower middle market space, you've got there's asset-based lenders that do equipment only. You've got asset-based lenders that do real estate only. You've got asset-based lenders that do just receivables and inventory, or just receivables, kind of like a factoring, the factoring companies.
There's a couple out there that will do just inventory, but they're few and far between because it's such a hard asset class.
It's a difficult class and very expensive. And so there are situations where we refer something out to an inventory-only lender. And we do have conversations, and that's a tricky asset class to lend on standalone. And those lenders get high interest rates for a reason, just that there's a lot of risk.
Absolutely.
Sure.
So,
Absolutely. And then, to your point, like the pricing can change between all these. So
For sure.
if you have a lender who's willing to take on really risky deals just because they see there's enough collateral.
Yeah.
And then there might be another lender that prefers something that's more in like that stabilization space. They're not going to be comfortable with that. But this other lender, like there's one lender that we've used many times over the past, just because they fit a box where they're mid to high teens, or low to mid teens, I should say. Very short term, no prepayment fees, all that kind of stuff, because they literally understand we are here just to bridge you to your next lending situation.
For sure.
But then, you've got asset-based lenders that are in, mid to high single digits, and then you've got that next level, and then, once you get into some of the other stuff, you get to the more expensive lenders that aren't in the asset-based space.
Right.
But
For sure.
But there is a different risk tolerance to every lender, right? There's different
sure.
size transactions they want to look
sure.
at.
Yes.
Do you see like industry specific? Like are certain lenders like, okay, I can really get, like you brought up transportation earlier.
Yeah, right, for sure.
That's a very specific
That is
asset class that.
That is so transportation is and even healthcare has some unique.
Absolutely.
And so you have a sort of a sort of a cadre of healthcare ABLs that really understand that industry and that are very good at that. And we send healthcare opportunities there. Well, transportation is another one where, again, there are certain lenders that have institutional knowledge of the transportation industry, and that gives them they're better equipped to handle the risks.
Yep.
So there are, and in terms of structure, asset-based structures, you're going to find they're going to be better equipped in the inventory that we touched on. But yeah, I would say pricing can vary. A large ticket asset-based financing could be, not much more expensive than bank financing. Could be, again, SOFR-based pricing of kind of a couple percent.
Right.
And then to, very expensive inventory lenders that are going to be, prime plus 10 or 12. And, maybe more if you sort of bake in the fees and costs and things. And so that's really, the full gamut.
Right. Okay, perfect. I guess maybe something you can work us through, because Joe and I have talked about this separately off the podcast, but it seems like private credit has been coming into play a little bit more. Are you seeing that in your space, whether ABL lenders are kind of carving out a wing of private credit, or are you seeing it a completely different market, unrelated to you guys, but equally competitive?
I don't think it's so. Private credit hasn't come down to the lower middle market yet. Yet. I think that they're certainly in the middle market space, and I think that they're a formidable competitor. But I think time will tell, if they really have, look, I think they're in the origination phase of booking deals.
Yep.
And so everything's working in the portfolios. And it takes time for some of those deals to season, and maybe some of them don't work, and maybe some of those credit boxes that they're offering changes. But I would say private credit is a growth business. It's an unregulated business. You find lenders that are insurance companies, institutional funds, just people that had a banking or commercial credit background, and there's a pool of capital, and that they're comfortable making loans and offering really just a wide variety of structures for a price.
Yeah.
And so
but the price can be very cost competitive sometimes.
They can. And an example I've given recently is, it wasn't something that I bid on, but this would be more of a middle market deal, acquisition financing, that the buyer went with private credit for really maybe 150 basis points in terms of additional cost. Didn't have any financial covenants at all for 21 months.
Wow.
And so the buyer thought that was attractive based on certain performance characteristics of the business that he was buying, that they were buying as a fund. And so they felt that was important to not have covenant tests. And so I would consider that a relatively tiny premium for not having any covenants for almost 2 years.
Wow.
So that's why you say the story's still out on that. It's yet to be seen, just because Look, they are taking some higher risks without the, maybe let's say, the appropriate return attached to it. I mean, for 150 basis points to have, to have those kind of metrics thrown at you, like, hey,
Right.
that's
what do they know that
not
I don't
so bad.
know?
Yeah, right.
But so I think what's interesting about it is, they're pricing deals and offering structures based on models,
Sure.
which could be right,
Yeah.
or again, whereas most of us in the commercial lending or asset-based field, we're making loans and offering structures based on actual historical experience of
Sure.
performance. Here's what loan loss rates are, or credit risk is with these types of situations, so we know we've got tangible experience. Whereas I think the private credit world is really basing their pricing and their structure. Obviously they have experience at the management teams, but again, I would offer that it's based on models.
Yeah.
And I think there's risk there.
Yeah.
Important consideration of that too is I think that speaks to the bloat of capital out there.
Yeah.
That it needs to be deployed.
For sure.
So we have to find a new way to get it out.
Right.
Right. Essentially. So to your point, with it being kind of early in its lifespan, we'll see how it shakes out.
Yeah. It'll be interesting.
Yep.
Any other developments you're seeing in that in kind of the ABL world outside of private credit, or is it kind of pretty established? And
I would say, so broadly speaking, our business is pretty good right now.
Yeah.
And so I would characterize it, we're still sort of post-pandemic. And I think that you had these government programs that provided financial resources for companies to kind of help them, which was important. And I don't think anybody said, hey, we shouldn't do something, but we should, and we did. I think part of that was also, I think the banks being candidly good civic servants or kind of good neighbors, I think treated many of their underperforming clients, well, I would say kid gloves, but just, they were forgiving, maybe based on, client performance, might get sort of sent to work out, but because sort of we're kind of in the pandemic or post-pandemic era, that maybe companies were given sort of special dispensation. And so I think that that's kind of wearing off.
Yeah, free money is going away. You can say
free money
it.
has gone away, and I think the bank's attitudes are returning back towards, okay, what's normal?
Yep.
Sure.
So you got a company that hasn't made money for 2 or 3 years. What's the appropriate risk box for that company to be in? And so we're seeing, I would say, a modest level increased activity in terms of banks really seeking an ABL partner for clients that need to go someplace else.
Yeah.
And so I wouldn't call it robust, but I would say it's,
So nothing's really changing in the ABL industry. It's more private credit kind of encroaching on the space more than anything.
I think
but
it's the
ABL is established. Like it's a tried and trusted product that where it fits the box.
For sure. I think the private credit people just, they're deploying dollars in bigger pieces.
Yeah.
Right.
And so I don't run into them.
Yep.
But if you were to be talking to like a bank ABL person who's looking at 20, 30, 40, $50 million deals, I think they would have a lot to say about the competitive pressure that they feel.
I have heard that. I have heard that. I've talked to those guys. Yeah. I will tell you, they are saying that they're starting to look better. Their pipeline's starting to look stronger. All those kind of things. So, like you said, I think that free money had to run off, and now industry's starting to normalize and all those types of things. So, okay. So now we've talked about kind of what's coming. What do you expect from your borrowers from reporting and all those kind of things? What does a term sheet look like? So what are the normal terms of financing for an asset-based lender?
For sure. So I'll speak kind of broadly about the industry. And so typically pricing is broken down. You have the spread, like a bank loan, prime plus something, or SOFR plus something. You might have what's called a servicing fee on top of that, which kind of pays for kind of the back office people doing the daily monitoring of the loan. You might have an at-close fee or an annual fee of some dollar amount. You'll have a cost for the periodic collateral audits. And then you might have what's called an unused fee, which again is common in the banking space, whereby if you're offering a credit facility of a certain size, but the borrower is not fully utilizing it, then there's some additional income on that.
Yep.
Now,
because you have to reserve those funds for that client, right?
Right.
It's not like you can go lend that same
Right.
money to somebody else.
Now, in terms of my own shop, what we do, we're trying to be super simple, super clean, and so we don't charge some of that stuff.
Okay.
And so our sort of structure is there's a prime plus spread. Sometimes there's a servicing fee, but I would say most of the time I don't charge a servicing fee.
Okay.
And we have a 1% annual fee on the face amount. And then we have our periodic collateral
Is the
audits.
1% annual fee because you have 12-month contracts, or is it and it's like a renewal fee, or is it just an annual fee?
It's more or less a renewal fee.
Okay.
Kind of more or less. I mean,
Yeah.
typically we're looking for like an 18-month contract or a 24-month contract, but yeah, it's all just part of the income that we kind of bake into our pricing model.
Yep.
And but we just try to keep it simple. We're trying, in terms of our own philosophy, we're
Right.
trying to not have all these different fees. Just simple.
Yeah.
Hey, it's going to be
I like that.
prime plus 3.5 on what
Yeah.
you use. 1% annual fee. Probably 15 grand a year for other costs. That would
Yeah.
include the collateral audits and the lockbox costs.
I like that you do the 1% kind of flat, because it does. Look, I get clients who would ask me, like, what's a collateral management fee? Like, what is
Yeah.
that? Why am I doing that? Isn't that already in my cost
Sure.
of borrowing? It just simplifies a lot of those
For sure.
things. So I like that structure. And then, obviously you're in some of these situations, you're looking for them to go back
Yeah.
to their previous lender. Like
For sure.
you're acting as an interim. But on the other side of that, sometimes you're going to end up with a situation where they choose to stay with you, right?
For sure.
And I've run into this situation. I
Yeah.
placed somebody in 20 that should well be out of their ABL lending relationship, and they are still with that lender now because it's just simple. They like the relationship. They kind of stay out of their hair.
For sure.
All that. Do you have maybe?
We
I'm
do.
sure you have a lot of those clients. Do you have any examples
Yeah,
of
I
that?
do actually. So I've got a great one. I think that companies stay sometimes for different reasons. Sometimes the owner likes to take a big salary.
Yeah,
sure.
And so, hey, he's going to keep that balance sheet extended, because he or she wants to live a big lifestyle, so he's comfortable paying additional cost of capital, in order to fund that and have that. I would say sometimes if a company had a negative experience with their workout banker and they really had a bad experience and it was kind of scary for them, then they may choose to stay in asset-based financing longer. I think in some industries that are very, very cyclical, so I've got one right now that's a very cyclical company, and I think they decided to stay. I think they decided to stay because they don't know where the economy is going to be in a year. I think there's some trepidation there, and they don't want to. They could go to back-to-bank financing, but they might be sort of to use the term fragile again, but kind of fragile or sort of a tweener
Right,
bank
in between,
deal.
right.
And then I think they're afraid, like, hey, well, what if 6 months later I've got a bad 6 months?
Yep.
Then I'm rolling into a new bank, and so I think they're just choosing to stay for a little bit more, kind of bolster the balance sheet a little bit, and kind of make sure
Feel
things
really
are-
comfortable with where they're at.
Yeah.
Yeah.
Okay. Well, obviously that's a good example. You've seen a variety of examples.
Yeah.
Talking about ABL a little bit more broadly, can you walk us through maybe a situation that didn't go through so well? Go really well.
Sure. I mean, just in terms of like a refinance, like maybe a borrower that needed to leave their bank, and
Sure.
Yeah, I mean, I'll give you an example of actually a company here in town that really they lost money for years. I mean, literally years. And you had, as we all know, you had an entrepreneur who was very successful and built up a terrific company, great balance sheet, super strong net worth, and the second generation was not as skilled, and slowly dissolved that balance sheet, and so. Probably a couple of years ago, they closed down. There wasn't really a turnaround plan for that company because their industry, some fundamental features of their industry changed, and they couldn't. They could be the best operator in the world, but there's nothing they could do about that. And the right decision for them really was to have closed or this company was subject to outsourcing in China. And so they were a high-cost producer here in the U.S. And, what's good about this company, they were very loyal to their U.S. employees. And they continue to operate at a loss despite the fact that the pricing that they could charge was based on a China price.
Yeah,
Sure.
right.
And so that was an unfortunate situation. They were eyes wide open. We were all eyes wide open.
Yeah, right.
Hey, there's tremendous equity in these assets. We can continue to give you runway. And I think they were just looking to try to stay in business long enough to hopefully maybe the fundamentals of their space would change.
Okay.
But they ultimately didn't. And the family decided to just,
Hold up shop.
they'd had enough.
Yeah.
Sure.
So
Okay.
Well, it's good to mix in the good stories, the bridge, the stabilization, back to the senior floor, with some of the realities.
the reality is, the good news is I would say a very small percentage of our clients are ultimately unsuccessful. So I would say less than 10% of my clients,
Have that.
They usually figure it out, right?
They do.
It's just the reality of it.
Yeah.
Right.
Like whether it's a new line of business, a different industry that they start focusing on, whatever it is, they usually figure it out.
Sure.
They just need the time to figure it out.
They do need the time. Yeah.
Yeah.
In many cases, these were successful people that got themselves here or to a healthy position, and they just need some time. They're smart people and they're hardworking people, and they need some time to figure it out.
Yeah.
Right.
Okay, very briefly, I did let's spend just a minute or two on this. Where do you see the industry growing? Like, do you? I mean, obviously, you think it's going to grow a little bit because you're seeing like really good pipeline and you're having a good year, all those kind of things.
Yeah.
What do you think happens from interest rates? Like, do you think private credit starts opening, like forcing ABLs to open up their credit boxes a little bit? Like, what do you?
I'm actually so for sure our fundamentals are better. I would say 2 or 3 years ago it was tougher than it is today. There's more distressed companies out there, so we're having a good time. But I think that private credit is a feature. Maybe they ultimately get to the lower middle market space. I think it'll take them some time to get there. So for me, it isn't so much a factor. But I'm actually optimistic about banks, and I'll take maybe a bit of a contrary point of view. I do think that part of the reasons why we're doing well is the regulatory pressures that the banks have felt over the past 4 years. And to be sort of apolitical about the whole thing, I do think that the regulatory environment that banks are going to be under in the next 4 years are going to be different. And I think it's going to be better for the banks. And I candidly expect more risk-taking on the part of the banks. I would think that the credit boxes of the banks is going to expand either a little bit or quite a bit over the next 4 years.
Sure.
And that probably means I've got an additional competitor for that sort of edgier sort of a deal.
Yeah.
And so, but I wish
Or there's going to be a lot better
case.
credits around, and they grow
That
naturally
too.
with companies performing better and
Sure.
all those kind of things. And then, that leaves a very definitive subset that actually sticks with ABL, like people that should be with ABL.
For sure. And I'll again to be, I would say I would think that there's a reasonable case that lower middle market companies are going to be more optimistic going forward than they have been in some time. And this isn't a political, but it's but the people that own lower middle market companies, in my experience, are politically conservative people. Not everybody, but
of course.
generally speaking. And I think my expectation is they're going to have a greater degree of confidence, and they're going to be seeking to grow.
Sure.
They're going to have more confidence to grow going forward than maybe they have. They feel like maybe the economy is on their side, or they've got somebody at the top who's on their side. And these people, I think, my expectation is there's going to be opportunities to finance growth for the banks, and which will be very good.
Sure.
Yeah. A lot of changes coming.
Yeah.
Okay, so I think we did a pretty good job of covering most everything here.
Super enjoyable.
You want to give us maybe a few bullet points as we wrap up? Takeaways of ABL lending for somebody out there who either doesn't have much exposure or none at all?
Sure. So, we're looking to be a good service provider. I mean, I would say the ABL industry generally, the one or two sort of long-term clients, our job is to be a good service provider for the commercial lending, the commercial banking space. So, here's how I look asset-based. So we want to be working with our bank partners on deals that are too tough for the bank to do, whether that's a growing company that doesn't fit the bank's box, or a bank or a client that's struggling and doesn't fit the bank's box. And so we want to be returning that client to the bank in either one of those situations. So we really operate we want to be to the benefit of the commercial banks.
Sure.
And so we offer a pretty simple credit structure based on collateral. We want to be a really good financing partner for these companies. We want to be relaxed, even
Right.
if they're having trouble and maybe having losses. We want to be a relaxed partner for them and within the collateral, and give them the best opportunity that they have to sort of turn the business around. And so it's pretty simple, formula-based lending. Hopefully we can offer them enough to, again, get them out of their current situation and give them enough
Right.
new capital to fix their issue. And if we can do those things and get the company back to our, bank referral partner, that's a win. That is very much a win.
Perfect. Well, thanks, Shawn. I appreciate you taking the time and joining us on the podcast. Joe and I learn something every time we have a guest on with us, so thank you for that. I think the dilution rate, that 85%, where that came from, was good knowledge. Just because it was a number out there for me, but I didn't know the source of it. So, thank you for taking the time and walking us through kind of your industry and your shop specifically. Hopefully, if anybody has any questions, either for us or for John specifically, reach out, let us know, engage, leave comments, subscribe as always. So let us know. But thanks, John, for joining us. Really appreciate it.
It's been a great conversation. I've enjoyed the other episodes, and I love the conversation and sharing a little bit about. Again, we all have sort of a spot in the space, and we're one of the niches.
Right.
Yep.
So.
That being said, we always wrap up the episode with someone providing a space where they like to go for some kind of business interaction, whether it's you're going for a meeting with a potential client or a referral source, or the closing situation where you go to celebrate, or just catching up with somebody in the industry that you end up seeing 30 people that you work in the space. You got a great space that you like to go to for any kind of business situation?
Oh, for sure. So I would say Toast for breakfast, and so Toast in Birmingham for breakfast. And I would say every time I meet somebody there's at least 2 or 3 other deal people.
Yep.
Sure.
All in the red booths. We're all sitting around. Everybody's doing their own thing.
Right.
But I think it's certainly a great place for a coffee and a breakfast, but also to be seen and to do a little bit of informal networking and chatting up maybe people at the table next door.
Absolutely.
Sure. It's a good spot. It's our first breakfast spot. So thank you for bringing that one to us.
My pleasure.
Yeah.
And I'm starting to notice a trend that the Birmingham Bloomfield area is where a lot of our industry is
a little
housed.
concentration. Yeah, absolutely.
Well, thanks for everyone for listening. Please remember to check us out on LinkedIn, YouTube, Apple, Spotify, now TikTok. We are on Instagram, but that's most of the clips. So for that, we'll have to get a Facebook page started at some point. But we really appreciate everybody listening. Please please subscribe, do all those good things. As always, I'm Joe Allen.
I'm Shawn Racino.
And this is Making the Deal, Frameworks for Transactions. Thanks for joining us.
Appreciate it.